Hi, everyone. I'm here with Stuart Murgatroyd today. He's the CEO of Data on Demand. And Stuart, you guys are in the data analytics, data gathering, data bureau kind of space. And I know you've done a huge amount of work looking at certain segments of the population, looking at things like, I suppose, financial difficulties, those kind of things. And I know you're expanding into the vulnerability world as well. But I suppose to start off, I suppose the first question was really just to get your perspective, having been in this world for a long time and doing what you do now for a while as well. Have you seen the use of data changing and evolving over the last good few years?
Yeah, thanks for having me back, Chris, after being on a previous podcast. And yes, so we would classify ourselves as a data aggregator. So collecting lots of data from different sources and creating a single customer view, a universe, if you like, with lots of information about individuals and a huge amount of information, actually. I think at the moment we process around 80 million records for UK individuals, UK residents, everything associated to the UK address. Now, there are not 80 million living people, but for the products that we produce, then we want to see people that are alive, people that are dead, people that are duplicated, people that are fraudulent as well.
Mm.
So over the last 5 years, we've seen the data world evolve quite incredibly, really. Not so much in terms of new participants into the data world in terms of service providers, but the data that's being collected. You've got the advent of open banking, of course, and then you've got all the other different data sources that are out there in the ether. Typically, you've got your credit reference agencies who have got shared data. Then you've got other people like us that are collecting data in different ways. And I think that's where the real change has been seen over the last 5 years. And especially when you're looking at different regulatory requirements, such as vulnerable customers from the FCA, there's now a requirement to go out and find information about people that was never really needed before.
I mean, because we were really largely reliant on what the customer would say. And it feels like we're moving into a much more sort of data rich kind of world, which we've seen outside of the industry to a certain extent. But it feels like that's like permeating through, which is it's almost like you now need the data. And it feels much more that people are going out and looking for data to be able to identify to do things. And that feels like a bit of a change than even 5 years ago, where you have customer conversations, you might have internal data, and then you might have external data, which would traditionally be just sort of like the bureaus, really. But now it feels like we're out there looking for more sources and new ways of looking at it. And of course, we can process it more as well to really understand what's going on.
Yeah, I think that's probably driven by the regulator, actually, especially for the vulnerable
Mhm.
customers, where they're asking businesses or service providers to identify more people who they would deem as vulnerable. The FCA is saying that 50% of people are vulnerable. When we're talking to customers and doing evaluations with businesses, then what we're typically seeing is that people are able to identify up to 10% of vulnerability or vulnerable customers. And actually, more often than not, it's lower than that. There's almost a number that I hear regularly now, 3 to 4%, where
Mhm.
people can identify the vulnerable customers in their customer base from two things: either information that's being given to them by their customers, or information that they've been able to glean from their customers. So you've either got people telling you, "Hey, I'm in a difficult position here. Can you help me?" And you've got other things like software that enables you to listen to what people are saying and take keywords from that and then assign some vulnerability on the back of that. But the problem that you have is that not everybody, and probably the minority really, will tell you that they've got a vulnerability. And often the case for that is that people think there won't be a good outcome for them if they say, "Hey, look, I'm struggling," or "Something's happened and I can't pay a bill this month," because they feel that the credit facility typically will be taken away from them, or they'll be punished for admitting that they're not in the best of places.
Mm. And I suppose, yeah, so what extra kind of data sources can we go out to understand the vulnerability? Because it does feel like, particularly with consumer duty, as you say, like we're being asked to try and look for it. And if it's not been declared, you need other ways to be able to say, then how do you identify those people and then go out to talk with them? So what else is there that we can really look at? Because it feels like we're looking for those like small indicators. So now I need to have a conversation with you to get over that trust barrier that you're just talking about.
Yeah. You've got some great companies out there doing some great things like Policy and Practice, for example,
Mm.
are able to use the benefit calculator to help people find which of their customers are actually eligible for some more money. You've got Andrew Gethling running the Morgan Ash business, putting out the surveys to people with the vulnerability questions, asking them to respond to those questions and actually give information back to the companies Then you've got businesses like us, and we've just launched a new product called knowyourvulnerablecustomer.com, and we're calling it KYVC. Everybody knows KYC, Know Your Customer. KYVC is Know Your Vulnerable Customer. What we're doing is pulling in multiple external data sources to do what we do best, which is aggregate data into a single customer view and make that available to our customers. What we have within that data set in that universe is some data from a product that we produce called IDView, and that's for identifying vulnerability. And that information comes from high-cost short-term loan applications. They're great for really rich data that aligns with the FCA's characteristics of vulnerabilities, because they show you a lot of insights that are the same as the ones that the FCA want to identify in order to pinpoint vulnerability. We have data in there from Infineon, which is a similar source, which is the high-cost short-term loans. We bring in a mortality manifest, which is a deceased and bereavement database. We've got policy and practice in there as well. And then we've got the vulnerability registration service that lots of people listening to this will have heard of. And then we've got the insolvency register in there as well. And what we're trying to do, or what we have done, is brought together different data sources that identify the characteristics of vulnerability that the FCA talk about. So things like an income shock, a relationship breakdown, a bereavement, loss of earnings, a changing working status, things like age, lone carer, single parent. And from these different data sources, you're able then to aggregate into a single customer view, match that back to the customer's data set, and then actually pinpoint individuals that are going through negative life events or are struggling in general. The VRS data within all of that not only helps to identify some financial difficulty, but brings in the mental health problems and the physical disabilities as well. So it's a great aggregated view, holistic view, really, to be able to say which of my customers are really struggling and what's going wrong. It adds a bit more weight to the CRA data, where you have got people that miss payments, you have got people in arrears, but that's reported in arrears. It takes a while for people to get into that situation.
How do you think about it? I suppose I'm hearing what you're saying. I'm thinking about Venn diagrams, actually. So if I got the Venn diagram of all of my customers, we've probably got other Venn diagrams you overlap where there's an intersection. So for example, your data here is providing really rich data on a subset of those customers. And as much as we like to, a lot of us will be out saying, look, I want to look at the whole pie. But the fact you've got richer information on a small piece of the portfolio isn't necessarily a bad thing, because you're actually providing extra support for those people. How do we need to think about almost like overlapping data sets, because we don't have perfect information on everyone. And although we might like to say that we want to have that, it's not the reality of things these days. And we're getting into this much more like complex kind of data world. And I suppose for vulnerability, it probably doesn't matter, because you're providing extra support for people who need it, right? You still have the issues of the people you don't have data on, but for the people you do have data on, it's adding value. How do we start thinking about that and getting comfortable with that and adding these almost like multi-layered kind of data overlays, really? And you'll have that even within your KYVC, right? So you have different data sources. You probably don't have that complete population for everyone from every single data source. It feels like there's something we've got to get used to there in terms of dealing with maybe incomplete data and just really understanding what the nature of that data is.
Yeah, absolutely. Where you can't find any information, you don't have information. So there's not a lot you can do. But where you can find information, that allows you to take action. So what KYBC does is allow you to pinpoint down to an individual level and find the people that really are struggling. And that the Venn diagram is a good example, because you might have someone that's taken out high-cost short-term loans to pay their bills, but that might overlap with the fact that there's recently been a bereavement in the family. And that could overlap with the fact that they're also going through an IVA. So you can actually bring all these data sources together and stack them up to create an even higher level of vulnerability at an individual level as well. And those are the people that you really need to reach out to. But you're right, this isn't a complete solution. You need to work in tandem with different data sets in order to get as large a coverage as you possibly can. So the amount of data that's in the KYBC product is probably around 10 million people, but that's not anywhere near the amount of vulnerability that the FCA says out there and is actually out there. So you need to combine what we've got with other sources as well. And probably the first place to go is the credit reference agencies, because they've got a lot of data and they've got a lot of model data as well. and they can give you a good wide view, if you like, of vulnerability, but they can't pinpoint down to the individual level like we can of the people that really need your help. And the point is that we're able to pick things up before things are seen at the credit reference agencies. So you've got your arrears and your late payments, and even as far as going into IVAs and insolvencies, that's great. Those are things that are happening. Okay. And we know that's happening right now. But what were the causes of that? What made those things happen? And that's what we're able to do is look back and say, actually, Mr. Smith got into debt, and we can see he got into debt in December. But if we look back in June, we can see that he got divorced, and we can see that Mr. Smith lost a job. We can see that Mr. Jones reduced his working hours. We can see all these different things, these different insights and indicators that lead to that vulnerability. So it's about trying to pick things up early in the customer journey or the customer lifetime. If you're a lender, when you lent someone money for the car, it was maybe 2 years ago because they're taking out a 5-year loan with you. And 2 years ago, they were great. They were married, they had a job, and everything was good. But since that, things change, and vulnerability isn't static, and it can be quite transactional based on different circumstances and how those circumstances change. So someone obviously went through a credit check and they were good for finance 2 years ago, but things change over a period of time. And it's actually taking the data that we've got, looking at your existing customers and saying, where have we got some changes in our customer circumstances, and what can we do about that in order to prevent any greater harm or them getting into any further debt or anything worse than that?
Yeah. Well, it does seem like there's some maturity around understanding data, isn't it? It's like, how do you get much further upstream, which like avoids harm as much as possible, but then looking for those smaller indicators much earlier. And I suppose then it becomes an easier conversation with the customer as well.
Yeah, absolutely. And I think the consumer duty has evolved, and what the regulator wants from the providers has evolved as well. And it's taken them a long time, but now there are actions that the FCA want providers to take. And most firms will have in place the actions and objectives that they have to put into place if they find vulnerable customers. It's just that they're not finding enough of them. So they're not being able to do as much as they could do if they could find more.
Yeah. What are some of the early indicators, I suppose, that you pick up that we should be looking out for? So rather than waiting for it to, because by the time you're calling in and declaring yourself as vulnerable, you might be at the point where it's at that point of sort of desperation, really, because you're probably in arrears, you probably you're at the point where you want to talk about it. But what are some of the early indicators we can broach with people to say, but maybe there is a conversation there that we need to have and we can help you much earlier?
Yeah, so the FCA would talk about low financial resilience. So if we see someone applying for a high-cost short-term loan for the first time, or we see someone applying for a loan application for an emergency expense, or someone applying for a loan for short-term cash, or someone applying for a loan for reduced income, that's a characteristic that shows they've got low savings, or their main source of household income isn't what it was. The FCA talk about low financial capability, which is a loan application to repay debts, a loan application to pay household bills. And that's a sign of over indebtedness that the FCA talk about as well. You've got things like working status. If someone took out a loan and you had a policy or a risk appetite just to lend to people employed, if they've changed to self-employed, part-time employed, temporary employed, that can be an indicator of low or erratic income. And then you've got things like financial disruption and a change in employment status, loan applications for reduced working hours. And that's what typically the FCA would refer to as an income shock. And then you've got things like income source. If people's income source is from benefits or from a pension, that indicates low or erratic income as well. And you've got wider things like demographic groups. So people aged 18 to 35 typically are at higher risk of financial instability. And then you've got people over 65 that, again, they've got low digital capacity, they've got fixed income. Yeah. So again, those can be things to look for. Lone parents, single, divorced, separated, widowed, that kind of stuff. So there's about 50 different indicators or insights that we've got on the database.
And have you been seeing those sort of change over time? And since we last chatted, quite a bit of water's gone under the bridge in terms of the changing dynamics. Have you seen, you've got quite a good finger around what's happening from a financial resilience point of view, but also from a vulnerability point of view in terms of what's happening in the economy? Have you seen like changes happening? So we've had cost of living since, we've been going through the pandemic, and that's sort of changed and faded a little bit. What are you seeing now in terms of some of the themes that have been coming through? Anything in particular?
It's interesting, actually. So what we have seen and what we can monitor quite closely are the loan applications and the purposes for them. So what you saw during the point at which the energy prices rose was a lot more people borrowing money using high cost credit to pay household bills, pay electricity bills. That's changed actually now, and it's dipped down to a much lower percentage. And you're seeing people borrowing money again for more kind of day-to-day things. So actually, we've seen an increase in short-term high-cost borrowing or subprime borrowing for motor finance because that finance has become more readily available. Even though the interest rates have gone up, it's still become more available for people. And after the pandemic, people feel more comfortable now to take on loans and spend money on things they wouldn't have done perhaps before. And obviously through COVID, we all know that people didn't have to spend as much money. And you looked at credit card spending and it went right down and people were clearing credit cards because they had more income because they weren't going to work. So you see changes all the time, very much dependent on what's happening in the economy and what's happening around the world at the time as well. But there was a direct impact with the energy prices going up with the short-term high-cost loan applications for household bills. Yeah, changes all the time.
And I suppose from a lending market point of view, that kind of sounds like it's almost like the stability that people want to be able to look for the future in terms of borrowing money. It feels like that we're in a more stable kind of world from a lending market point of view. So that's probably people feel more comfortable in terms of borrowing money now than they did at the end of the pandemic. But the cost of energy was just a bit of a spike that kind of came through. That's kind of interesting in terms of, I suppose, in terms of the dynamics that are going on. So we're in this data kind of ecosystem that's like building. Where do you think it goes from here? Because it feels like we're just getting more and more data that's coming through. We've got consumer duty in the background. We've got board reporting that's coming out. We're now on the second year of board reporting. How does the data infrastructure play into particularly things like evidencing and those kind of things? What do you see the future of this kind of like the data ecosystem that's being built really?
I think in terms of evidencing, it's going to play a bigger part. Like you say, in terms of the board reporting, then the FCA wants to see a lot more information in there about the vulnerable customers and what companies and firms are doing to actually identify people and show an increase in identifying the number of people. But the thing about data is it always grows and it always changes. And if you have data about individuals, people are doing different things all the time and circumstances change. People get divorced, people get married, people die. And on the back of that, people's financial circumstances change because that was one income and there's a mortgage to be paid and actually the person that was paying it isn't here anymore. So the data evolves, the data changes, and that's all based on the customer's changing circumstances and requirements. So it's always going to be absolutely key in terms of being able to identify vulnerability.
And from a client point of view, I suppose when you talk with customers or clients, how do you find their receptiveness to in this market around getting extra data? Because it does add a complexity. And then I suppose the follow-on question to that is then, so having spent time in a lot of sort of detailed data sets, I mean, like the number of things you can come up with and the amount of analysis you can come up with is almost infinite. It's probably not quite infinite, but it's almost infinite. It's like, how do we narrow down to make sure we're looking at the right things and making sure we're staying focused on the right things as well? So what's been the reaction been to this and these new kind of innovative data sets versus more traditional ones, such as some of the credit bureau data, which has been quite well established?
The reception has been very good because there isn't anything like this. This hasn't been built before. It's the first time it's been done and the first time the data has been aggregated in this way. And quite a lot of the data is only available through our IDV products. The reception's been great, to be honest. But what you're talking about before in terms of how do people get it into the system, how do they ingest it, how do they use it? Actually, I think people are being more receptive at the moment because they've come up with their strategies of how do they use it once they've got it. Go back 18 months and we were talking to people and they're very interested in it and saying, this is great. Look at all this extra information we can identify about people, but we're not sure what we need to do with it once we've found them. But it's evolved since then, and many more firms now have that strategy in place to deal with and communicate with the individuals when they can pinpoint the different vulnerabilities. And in terms of making it easy for the users, we've aligned the information that we've got directly to the FCA characteristics of vulnerabilities. It's very easy then to report back to the FCA to say, yeah, we've been able to increase our site to vulnerability by 5, 6, 7, 8, 10%. And these are the reasons why. And this aligns exactly with what you'd asked us to look for. So it's very tangible in terms of enabling the people that use it to be able to go back to the FCA to evidence that they have been able to increase their view of vulnerability. But the thing with the product is that you can dial it up or dial it down. So different businesses will have different objectives in terms of the percentage of vulnerability that they think is valid. And the FCA will have their own view on that as well. We're working with a challenger bank, and they could see about 3% vulnerable customers across the whole customer book. And we took that customer book and matched it back to the KYBC product, and we increased that from 3% to 7%. So not huge, but we doubled it. If you think challenger bank with a couple of 100,000 customers, it's actually quite a lot of people. But when we delved deeper into where the vulnerability really was, it was the arrears portfolio. And when you looked at the percent of vulnerability in the arrears portfolio, that was at 25%. And actually, those are the people that you really want to be helping and reaching out to. And it's the people that have got into arrears, enabling you to say, I can see Mr. Smith has had a divorce, Mrs. Smith has had a bereavement, Mr. Jones has lost his job. I get it. They're not just not paying because they don't want to pay, because you've got the will pay, the won't pay, and the can't pay. And these are finding the people, the can't pay people, and the reasons for, but offering them something to get them back on track. And it's all about better outcomes for the providers and the customers, and ultimately for the customers.
So going from 3% to 7%, that might not sound like a large number, and as you say, it's doubling. But these are also customers who probably have characteristics of vulnerability that weren't identified before. And so until you actually got that information, you wouldn't have been able to provide the support. So it's actually really, so even then it's actually helping people outside of even just when it's a much larger percentage in terms of the collections portfolio. And that I think comes back to, it might be a subset of a wider population, but actually it's around like, how do you extend support to real people? And that's valuable just in terms of just the sheer number of people there are.
Yeah, absolutely. Like you say, 3 to 7 doesn't seem like a lot, but it is doubling it. But when you have a percentage of a couple of 100,000 people, actually, if you think it's another 2,000 people, 3,000 people.
Quite a lot of number of people on there.
Well, it's a lot of people. And then if you attribute that back to the loan value of an average loan value of £4,000, suddenly actually it's a huge amount of debt that's being incurred by those customers. And you really want to do something about that.
And obviously you've launched this business, and you said that you've done I know you did a lot of work to get the initial product launched, delving into the detail and understanding the data there and being able to provide it. How have you found in terms of like the rollout of that? You talked a bit about, I mean, there's so much you can do with data, and it's almost like it becomes, from a customer point of view, it almost becomes too wide. Have you found it's been helpful to narrow down in terms of specific use cases, those kind of things? Because it feels like that's evolved over time, just what you're saying, to hear us almost like some canned versions of the data, almost like making it much more simplistic. But in fact, the reality is you probably go pretty wide with lots of other indicators as well. What have you found the best approach to get the use of the data up and I suppose get the use of the product up?
So a really good example is UK Power Networks here, who we did some work with for the PSR, their Priority Services Register, as a case study on the website. So UK Power Networks started off looking for the most vulnerable people. So they delved deeply into the IDV product, identified people in the beginning who were using payday loans to pay their gas bills, because these guys are helping distribute the energy to the network. And then they delved a little bit further. They reached a little bit further out, and in stages, they addressed the most vulnerable individuals first. But actually their market reach and the policy was leave no one behind. So they actually grew and grew that vulnerable base of customers to about 1 million customers, which is a large amount of vulnerable customers. But you had people from one extreme of someone who has just lost a job and been through a bereavement and is using high-cost short-term loans to pay their energy bills, through to someone that is over 65, that has a standalone insight. But the way they approached it was to look at the most vulnerable people first, and then move out to the wider sphere and leave no one behind. So that's how they did. That's a good example of being able to use the very clear targeted insights versus the wider demographic ones as well.
But I suppose going back to when you're going in to talk to potential new clients, is it around providing those examples or specific examples of it? I suppose the question is really around like, how much do you need to simplify your product to get people to understand it versus just the sheer breadth of the data you can use to do lots of complicated things. So it's like, how much have you found around like simplifying the product proposition versus actually the true power of it. And there's a bit of a balance there, it feels.
Yeah, I mean, we provide a free report. So what we're able to do is take an entire book or some samples from some customers and match it back to the product itself. And then we share that information with the customer so they can see for themselves exactly which customers, what percentage of customers are suffering from certain vulnerabilities. So it may sound complex, but actually it's a straightforward matching exercise to identify which of the customers align with the flags that we've got. And because the flags align with the FCA's characteristics of vulnerability, we're not creating something that doesn't already exist. We're highlighting to the service providers, these are the customers that show the characteristics that the FCA have said create vulnerable customers. So although it's complex to build the product and get all the data into a single customer view and have it all come in from APIs to create that fast feed back to the individuals, once you delve into the detail, you can see exactly which of the customers are the ones that need your help.
And I suppose in terms of the product proposition, though, I suppose in terms of growth, has the regulation really helped, or is a lot of people really out there looking for it? I mean, what's been the driver in terms of adoption?
Regulation has been the biggest driver, just like it was when AML and KYC first became mandatory. Although right now you're not forced to find vulnerable customers, but it feels like it's going that way, and it will become a mandatory exercise for businesses to get to a certain level of vulnerability within their customer database. There's certainly regulation, but to be honest, Chris, the phone's not ringing off the hook, and we haven't got hundreds of companies reaching out to us saying, "Hey, we want to find more vulnerable customers." It's us going out to market and talking to people about the product, but that comes as part of being a challenger business, because I'm absolutely certain that they will have reached out to all the CRAs, because that's typically the people that are providing the information for the affordability, the credit checking. So that's your first point of call. But the CRAs won't solve all your problems. So we're taking more of a direct approach to the people that are already using their CRAs to get on their radar and to be able to talk to them about how this product works and how that will complement what they do with their CRAs and increase that view of vulnerability to satisfy what the FCA want to see, but also create those better outcomes for them and for the customers.
It does feel like just as we talked about at the top there around how we're all becoming much more data savvy in terms of using data to understand situations, get ahead of the curve, looking for the different connected incidents that might mean that leads to something in a collection strategy, which your data can provide. As much as we're getting savvier with that, it does feel like the regulator's getting savvy with that, and albeit probably a little bit lagging versus the industry. And we're just spending a bit of time looking at the product sales data that's coming out in terms of what can be done with that data to look at identifying where there's been appropriate treatment or where there hasn't been appropriate treatment and the evidencing around that. And it feels like we're getting into that sort of almost like data arms race, which is you want to try and stay ahead in terms of identifying people as much as possible. But there's also this backstop with the regulator coming back and saying, look, we'll find out if you haven't done that. I don't know what your kind of perspective on it is. You're obviously storied in the industry from a number of different firms, but where do you think we're going from a data environment point of view and a data interpretation point of view?
Yeah. If we're talking about, is there going to be a comeback on the businesses providing services because they didn't identify the vulnerable customers when they should have done, then you only have to look at the DCA Commission at the moment and what's happening there with the redress scheme that looks like it's going to happen. Could there be something similar, PPI, DCA, that kind of stuff? Could there be something similar where people haven't identified vulnerable customers who have got into further debt and be caused further harm? And is there going to be a campaign to compensate those customers for the fact that the regulated businesses haven't done what they were asked to do when they should have done?
Yeah. You think using all the data and the technology we've got, it becomes easy to work out where are there pockets of where the treatment hasn't been maybe to the level that would be expected, particularly with hindsight. So you can pull that out. And I suppose the tricky part of that problem is then how do you get further upstream to identify those people before it happens or as it happens, to then be able to say, well, look, we've done something now, which then avoids it getting into that problem. But if you did get into that problem, then at least you've done the work up front, right, as well. So it feels like that's like developing.
Yeah.
And I suppose it's the investment in those early kind of indicators to then be able to evidence you've done everything you can.
Exactly. We're heavily regulated by the AICO in terms of GDPR and the data that we process. And what we always make sure that we do is that we document every single process and every single procedure. You're making decisions yourself without going to the regulator to ask them what to do, but you're following their guidance. So this is the same thing. And say if the regulator, the ICO, came back to us and said, why did you do that? There's a big bad outcome here. Why did you do that? We can say, these are the reasons, this is what we documented, and these were the risk decisions we took, and this is why we did it, and this is why we thought it was in line with what the regulations required. So that has to be the same for the businesses that are regulated by the FCA. The more you do and the more you document, then the better it is for you and for your customers. So, it's better to be proactive. So it's better to go out and look for other data sources. It's going to help you find more vulnerable customers, because then the regulator is going to say, well, okay, at least you did something. If you do absolutely nothing and just rely on the CRA data and I sent every customer an email asking to tell me they're vulnerable, I'm not going to respond to that. It just doesn't happen. So what else have you done? Nothing else. So that's not great. You're going to get a slap on the hands. But you say, well, actually, we've reached out to Data on Demand at KYBC. We've gone to Policy and Practice and we've found benefits for our customers. We've talked to Morgan Ash as well, and we've put together the vulnerability questionnaires. We've done all this stuff, and we've gone to the CRAs as well. Great, okay, that's still not going to solve every single problem. There will always be gaps in data, but that's probably as much as you can do right now. There's not more that you can do than that at the moment in terms of what's available out there. So the FCA would have to say, okay, it seems like you've done your best. And the question would be to the FCA, what else can I do? Give me some guidance. But it's always better to be proactive.
And I'm just thinking that's the stuff that needs to go in the board reporting in terms of evidencing what you've done and progress that's been made. If you were to get a magic wand in terms of extra data sources, where do you think we're going to come next in terms of new data sources coming through or new ways of looking at data that can identify these characteristics of customers in terms of potential vulnerability and financial stress, those kind of things? If we wave a magic wand, what's coming down the pipe, do you think?
You could look at AI, but AI really is only going to be a faster way and potentially a better way of modeling data. AI can't get you the data that we've got, because AI can't make a finance application on behalf of someone else at a certain point in time and put in their information. But what it can do is it can look at all the information we've got from all the applications, and it could say, these people are more likely to be at risk, so keep a closer eye on them. But CRAs and data bureaus have done modeling for a long time. So I'm not sure if AI is going to be the solution, the overall solution for that. But it certainly will help in terms of doing things faster. The thing is that data, Chris, you've got to get it from the individual, because those are the people that whose circumstances are changing, who are experiencing the negative life events, who are doing things that mean that they can't afford things anymore and getting into financial trouble. But there isn't a magic wand that just gathers all the information up. You've got to get that from the people, because they're the people who are giving it out. And this is the point.
Yeah. Do you think there are extra data sources that are out there that we could also include? I don't know if you're looking at that. You talked about overlaying PRS data, policy and practice data, those kind of things, in addition to your original data sets as well. Are there other data sources out there that you think we can aggregate in to get even more insight?
Yeah, definitely. And this is the first iteration of our product, and there's 6 data sources in there. And we'd love to add more and more. And there are other companies out there I've seen that are doing similar things to VRS. Teljo, I don't know much about them, but I've heard about them. And you've got the CRA data that could certainly feed into this product as well. You could take, the thing with the CRAs is they don't typically aggregate their own data, and they will have a different view of some customers. If you could bring it all into one single source and then give the service provider a view of everything and the ability to pick and choose what would be best for them and their customer base, then that certainly would be a way to do it. We have about 90% of the payday market in terms of the loans that come in. There are other subprime sources that you could put into that. Guarantor loans, you could put in information from people that are doing the IVA and the debt management plans, and we're seeing the insolvency register anyway. But there are other subprime sources as well. You're trying to find people that are, I guess, the kind of data that comes in from the likes of step chains or people talking to them. So absolutely, you could build and create a broader universe. And this is the platform, if you like, for that, with a really nice and a good amount, but a nice view of vulnerability of individuals, but you can certainly build on it.
And I suppose then, last off, where do you see this going in the next 5 years then? We talked a bit about new data sources. We talked a bit about maybe this is some like kind of analytical techniques, but it really comes down to what the data is and how we interpret the data. Where do you see this this kind of approach expanding over the next sort of 5 years or so? What's going to happen next, do you think? What's your view?
What's going to happen next? Yeah. I think what we need to do is keep on adding more and more sources to a universe of sources, so that there's a one-stop shop or one place where people can come to get all the vulnerability from. And Amazon for vulnerability, maybe something like that,
Yeah.
where everyone can access everything they possibly could. But there'll still be data gaps. It's always about plugging in as many new sources as possible and plugging those gaps, but there will always be gaps. But it's about, for the firms, doing as much as you can do with what's available to improve those outcomes for your customers and to do what you should be doing in terms of what the regulators ask you to do as well. And it's all about progression and evolution, step by step, and building on those blocks that we've already got.
Yeah. Stuart, thanks very much for making the time again. So it's fantastic. Great to hear a bit of a catch up of where you are. Sounds like you definitely got some big developments that have been happening in terms of like new data sources, focusing around the vulnerability piece. So it's great to see the evolutions, like how this can help. And I know from an industry point of view, the conversation just keeps on evolving anyway. So I think this is a great way of getting extra insight earlier to help customers. So really appreciate you making the time. Great to chat to you.
Yeah, great to catch up, Chris. Thanks ever so much.
Thanks.